It is, again, my great pleasure to welcome back Keith Weinhold. Welcome to Zoom at 8. I'm excited that you're here. I mean, a lot of things have happened since you were here last. I don't think we were able to really talk about anything negative that was going on 2 years ago.
You're right. That was the period of the housing market frenzy in 2021. January of 2021 is when mortgage rates hit their all-time low of 2.65%. Yes, we're in such a different place now. A big lesson I learned is that when it comes to real estate investing, the property is only the fourth most important thing. And most people put it first. Some people come to me for guidance. They want to grow their portfolio. They want to get into real estate. They get really excited about a property. And I have to tell people, you know what? Stop looking at properties. And if you like, Julie, I can go into why I often have to tell people, just stop looking at properties. This has to do with the point where we talk about real estate markets, Julie.
I would love to hear that, because that is not what we typically hear. Stop, right? Everybody says, let's go. Can you break that down for us?
Yeah, how in the heck is property only the fourth most important thing in real estate investing? The most important thing is you. What do you want real estate to do for you? You're at the top of this hierarchy. Are you looking for appreciation or cash flow? Or are you looking for tax benefits? You're just looking for a lifestyle investment like a nice beach house where you and your family can hang out at. What do you want real estate to do for you? You need to get clear on that first. And then secondly is the market. We can think of market in a few different ways, residential, industrial, and all that, but I think a lot of people think of geography. What market do you want to be in? And really, what market do you want to avoid? This second most important thing in the hierarchy of what makes a successful strategic real estate investor is the market. In my 21 years of experience, there is more risk in buying what seems like a nice property in a little hodunk town of 8,000 people out in the middle of nowhere where 40% of that town's employment is tied to the tungsten mine. Well, if you're going to have a residential or commercial property, you know, your fortunes now float on what's going on with the tungsten mine and what the price of tungsten is, because you're buying a property to keep it filled with rent-paying tenants. You've got a lot of risk now being in a small market. So I like to be in the bigger metros, an MSA of at least 500,000 to 1 million people that has employment in durable sectors, like long-term durable sectors like technology and medical that just continue to be expanding. Your tenant pays you rent income. They get that rent income for a job. So those are durable drivers in a market. That's second most important thing. And then the third most important thing, still more important than the property, is that team of professionals that you choose to surround yourself with. That could be anyone from your 1031 exchange qualified intermediary to your mortgage loan officer to that all-important property manager. I don't manage any of my own properties. Even when I own them in Anchorage, I sure don't manage them across state lines. The manager's the glue that makes this stick together. That's the team. And then fourthly, and only fourthly, is the property. Okay, now what do most people do? A lot of people have a bad real estate investing experience. Perhaps even most people have a bad real estate investing experience because what do? Instead of going 1, 2, 3, 4, they go 4, 3, 2, 1. They start with the property and they might get emotions behind it. For example, if you commute to work, your friend might commute to work and maybe they see this duplex building that they always admired. They think it's got great paint and nice landscaping and pretty shutters. And one day there's a for sale sign on it. And they always heard that real estate was a good thing to invest in. And they keep seeing this twice a day on their commute. They've kind of got emotions behind it. Well, they buy it because they see that it's filled with rent-paying tenants. Well, they led with emotion. And they led with something very arbitrary. They just happened to drive by it, not very strategic. So what do? They buy that property. It might work out, but what happens after they buy that property, which is only the fourth most important thing? Soon they learn they don't like managing it. They don't like having tenants that can text them at any time. So then they go out and try to find if there's a good manager in that market. The third most important thing, now it's too late. Now you're at the mercy of hoping there's a good manager in that market. And then secondly, they go up and try to figure out the market itself. And is there job contraction in this market? Or I really didn't even think of that. And then they go back to number one. Oh, does this property even do what I wanted it to do for me? I thought it was going to provide positive cash flow, but it doesn't, because I got emotional and I began with the property. So this is why I tell people, stop looking at properties, pull back, get strategic. It's only the fourth most important thing. Finally, to review, the most important thing is you. Second is the market. Third is the team. And then fourthly, and only fourthly, is the property that's simple, that's strategic, it's easy to remember, and now you're really setting yourself up for success.
That is fantastic. I was on a group and they were asking for suggestions. And somebody says, oh no, start looking at properties. And that is amazing input. Most people do not look at it that way.
Well, I got it wrong in the beginning. When I bought that fourplex building, it just happened to be in my hometown. And I actually got kind of lucky. The Anchorage economy was expanding at that time. So there was a little bit of luck in this. Had the Anchorage economy contracted, maybe I would have sold it, had a terrible experience. And Julie, you never would have heard of me then if that would have happened. So this is a lesson that I learned over time. And this is why last year, I sold my last Alaska apartment building. It's the first time in more than 20 years, Julie. I'm not even sure if you know this yet.
I didn't know you sold it, but you were wondering what you were going to do 2 years ago. You were thinking about it.
Right. It's the first time in more than 20 years that I have not owned Anchorage income property. And why is that? Because the Anchorage economy is lousy. We're losing population. We're losing jobs. Our gross domestic output is contracting. And again, the market's more important than the property. The market's the second most important thing. The property is only fourth. So I owned local apartment buildings that I held for about 8 years. They stayed well occupied because, like most everywhere in America, we have a housing shortage, but the rents didn't go up because the economy is not expanding. So my expenses went up, the rents didn't, they weren't very profitable. And I need to practice what I preach and not be emotional just because they happen to be in my town. And I traded up into those buildings because there are some good local financing options that I couldn't get out of state. But this poorly diversified market, much like the fictitious market I talked about of 8,000 people with the tungsten mine, this is a poorly diversified market. Anchorage, Alaska's market is very dependent on what happens in the oil industry, and oil throughput is down. We're a poorly diversified economy. So this is an example that you can extrapolate out to the way you break down markets as you go. Typically, the bigger the market, the safer you are. Safety is not my favorite word in investing, actually, but it is pretty important in this case. And actually, there's a little lesson from when I sold those 2 Anchorage apartment buildings. I had 10-year balloon loans on those. You may not know what a balloon loan is, especially if you're new to real estate investing. Actually, it is an apropos moniker, balloon loan. It's actually an appropriate name for what the thing is, because though both buildings were on 30-year amortizations, meaning the payments were spread out, like I would make monthly payments for 30 years, 10 years into that 30-year period, the entire principal balance is due in full. Now, why would I choose a balloon loan over a loan, 30 years of certainty? Because with a balloon loan, a 10-year balloon loan, I could get an interest rate about 0.3% lower. If I would have gone with a 7-year balloon loan, okay, making things even riskier, at 7 years, I need to fully pay that thing off. I could have gotten an even lower interest rate. But in my experience, pretty much any 10-year slice in the market on a nominal basis, it's very difficult for prices to go down. So if you ever get a balloon loan, like I had here, what happens as you approach that 10-year mark? You've really got 3 choices in what to do with your balloon loan when that entire thing comes due. You can sell, you can keep it and hope that you can refinance, or you can do about the least likely thing, keep it and pay it off yourself with cash, like 7 figures cash, which not a lot of people have hanging around. So I opted for the first one, to sell those buildings that were on a balloon loan. But now you understand a bit more about the market. Now you know what balloon loans are.
I'm going to ask the question. What did you do with the capital that you got from those sales? Did you 1031? What did you do?
Yes, I 1031 a lot of it. And where I've been doing a lot of my buying, Julie, is in Florida. That's now getting more challenged as Florida prices have run up quite a bit more than they have in some other places. But Florida is where I'm heavily invested. Actually, this is the first time one of the properties I did not do a 1031 exchange on. For those that don't know, the tax code gives you the opportunity to do a 1031 exchange if you're a real estate investor, where you can legally defer capital gains tax your entire life and never have to pay it. So I did the 1031 exchange on one of the buildings. On the other buildings, again, it didn't didn't appreciate much over 8 years because of a sagging market. I actually didn't do a 1031 exchange, and I kind of regret it. It kind of hurt me. I had to pay the capital gains tax, and you also have to pay back the depreciation recapture, all the depreciation you've been writing off every year. So I actually got the experience of not doing a 1031 for the first time. But yes, otherwise, Julie, it's in that southeastern quadrant of the United States is really where I favored, especially Florida.
Well, I would say that for our next interview, we'd love to go through that pain of not doing the 1031. And I mean, it's a challenge, right? If you don't do it, here's the reasons, that you get hit with. So that's unfortunate. I'm sorry to hear that, but I want to hear, Keith, about inflation because we've been worried over the last 18 months, right? About inflation. And we really weren't looking at it too hard. We've got economists, they call themselves economists that have not really lived in this economic issues, right? It happened before they were even old enough to know about inflation. So tell us about your thoughts on inflation and how they affect buying real estate. Right now, it's expensive to buy properties. They're coming down, right? Because of the interest rate. So talk to us a little bit about that in your view on inflation.
Inflation is defined as an expansion in the money supply. Most people think it's prices going up, but prices going up is really just a symptom of an expansion in the money supply. And I think an important word, Julie, is noticeable. When CPI inflation is near the Fed's 2% target, that's not very noticeable. It's really not much of a thing. And the dorky prop is about to enter, okay, when it comes to inflation. Okay, check this out. I purchased this in Anchorage, and Anchorage prices aren't that much higher than they are in the rest of the United States. We have a big port here in Anchorage. I purchased this, and there's quite a lesson from this right here. And you might be thinking, what is this? This looks like a bottle of salad dressing. Okay, yes, it is a bottle of salad dressing, and I pay $8.79 for this now. I'm a pretty healthy spender, but this even gave me some pause. $8.79 for this is just a 12-ounce bottle of salad dressing bought in a regular American grocery store. It does have the good stuff in it, like apple cider vinegar and extra virgin olive oil and all that, but still, that was pretty surprising to pay that much for a bottle of salad dressing. It was really emblematic of the high inflation that we've had for a few years. CPI inflation has now come down to about 3%. It exceeded 9% in June of 2022. That's where it peaked. So I think a lot of people understand why we have inflation. To deal with the health crisis, we had the $2.2 trillion CARES Act and the Paycheck Protection Program. And really in America, we now have this culture of whenever there's a crisis, whether it's the 2008 global financial crisis or the health crisis that spouted in 2020, how do we deal with it? We don't tell the citizens, well, you need to be living austere, and you should have been living austere these past few years so that you will have personal savings to tap into. People almost aren't incentivized to have personal savings anymore. You probably heard the stat that most Americans can't meet a $600 emergency. Why not? Why don't they? They've kind of been trained not to, because the government just paves over problems by printing more dollars. Whether you agree with the CARES Act or not, it's not a politically partisan thing. That's not it. This stuff happens under any administration. They just print things over and pave the world over with more dollars in order to make problems go away. And there is actual political expediency to that, because no president or congressperson wants to say that, oh, well, you just need to live austere and start eating beans and rice and get some savings build up. No way. They're not going to get reelected back into office. Both sides of the aisle do it. So the easiest thing to do is just print more dollars. All right, so what does this have to do with real estate investing? You can really take advantage of inflation. In a weird way, I'm almost like an inflation cheerleader. Yes, this inflation is not good for the average person, but I position myself as a real estate investor buying an income property with loans. Yes, I still get loans despite higher interest rates. I'm actually benefiting from this inflation 3 ways at the same time. I've coined the term, this is the real estate inflation triple crown. Asset price inflation, debt debasement, and cash flow enhancement are the three legs of the inflation triple crown. So let me just give you an example so you can understand this. If you make a $200K down payment on $1 million apartment building, say we've got 10% inflation, it might not be in a year, but just 10% inflation over a couple years. Your $1 million building just went up to $1.1 million in value. And maybe you're thinking, all right, so what? I mean, isn't that just an inflation hedge? How am I any better off? Aren't I right back where I started? If I now have 10% more dollars, but each one's worth 10% less? Actually, the answer is no, because you got a loan. You only made a $200K down payment. So your building value went up $100K. So did your equity. Your equity went from $200K to $300K. You've got a 50% return there because you're borrowing. You're getting the benefit of borrowing money. Secondly, when we look at your debt side, you borrowed $800K for this building. A lot of people don't realize this. This is the second leg of the inflation triple crown, debt debasement. If you borrow $800K and you've got 10% inflation, you only owe the bank back $720K in inflation adjusted dollars. See, the bank doesn't ask to be repaid in inflation adjusted dollars, just nominal dollars. And maybe you're wondering, well, what about the interest? Oh, the tenant pays all the interest for you. So an $800K loan with 10% inflation over time, you only owe the bank back $720K. It's only going to have the weight of $720K because wages are higher, rather, salaries are higher, prices are higher, rents are higher. And then thirdly, your cash flow in an inflationary environment actually goes up faster than inflation because you've got a loan on a property. And that's because your principal and interest payment stays fixed. As long as your principal and interest payment stays fixed, inflation can't touch it. So this is why cash flow outpaces the rate of inflation. So inflation is good for the leveraged real estate investor. And to bring it full circle, getting back to the dressing, that's why in a weird way, paying $8.79 for this seems like, it's an awful lot, but actually it's confirmation that I'm a profiteer because I've borrowed dollars for an asset that actually benefits from inflation. And it is kind of too bad for the poor person. A poor person, they can't really put assets in their portfolio and they're not going to be able to buy something like this. So you can decide, what side of this you want to get in on. So help use inflation to benefit your portfolio. You can watch this one next.